Good afternoon. My name is Shawn Neidorf. I am the Chief Opportunity and Research Officer here at the Arizona Commerce Authority. I'm glad to have folks with us today. I will let you know that we are recording this and we're going to put it up on our website. So if you miss anything or you have any questions, that will be available for you as we get going. I'm going to ask each of our panelists to introduce themselves. I'm just going to tell you which order I see you on my screen. So if you guys would go in that order, I would greatly appreciate it. So first I have Brian, then Mark, then Ed, then Brett, and then I'm going to ask Shawn to introduce himself. He is my colleague here at ACA and really our expert on all things maps and data. So Brian, if you'd kick us off.
Yeah, good afternoon, everyone. Brian Crum with Caliber Companies. We're a Scottsdale, Arizona-based real estate developer and asset manager. We were one of the first companies in Arizona that started creating a diversified portfolio inside the opportunity zones. And we've been able to utilize that to raise over $250 million of equity from opportunity zone fund investors and diversified it across a portfolio that includes hotels, hospitals, apartments, we even built a school as part of a program in the tribal community, and looking forward to exploring how not only the 2.0 program can work for Arizona, but also where there's some crossover with the 1.0 program. So excited to be here today.
Thank you. Mark?
My name is Mark Schultz. I'm a partner with a law firm called Snell and Wilmer. I'm based in the Phoenix office. We're a firm with 16 offices around the Southwest and DC. I co-chair our Opportunity Funds practice and chair our tax credit finance group. I've been doing OZ transactions since the inception of the incentive. Was involved when it was called the Investment and Opportunity Act, which was the predecessor legislation to the Op Zone, which passed as part of the Tax Cut and Jobs Act. We have set up probably about 450 qualified opportunity funds. I would say about a third of them are third-party sponsor funds. The other two-thirds are what we call captive funds. And our projects are all around the country, a large portion on the West Coast, but we have a significant amount that we do on the East Coast and Midwest as well.
Thank you. Ed? Ed, I think you're muted. I can't hear you. Can anyone else? Hello, Ed? Okay, I can see you, but I can't hear you.
I don't think his speaker is working.
Does that
There we
does
go.
that help?
That sure does.
All
Okay,
fixed.
my sounds like I got a microphone over here and a camera over here, excuse me. So Ed Grant, Scottsdale Investment Management. We're in the real estate development and syndication business. Started in 1977 with our three founding partners who are actually still involved in the company today. We primarily operate in industrial raw land, single family rental. We've got about $100 million in opportunity zone projects across a couple of different states. And we're working both in kind of in the gamut, I guess, from raw land all the way up to operating businesses. And I'm looking forward to the conversation.
Brett?
Hey, everybody. Thanks for having us. I'm Brett Siglin. I'm a partner at Fenimore and also been actively involved in the OZ incentive since the outset in 2018. Also work in the tax advantage tax credit space. I've been doing that for over 20 years. And yeah, we've represented a large variety of sponsors, developers, and investors, setting up QOFs, setting up QOZBs, and just kind of navigating the rules and the structure, setting up private placement offerings and the like. Excited to be here.
Thank you. And Shawn?
Hi all, I'm Sean Cesario. I'm a project manager on the economic development research team here at the ACA, and I've been handling a lot of our mapping requests. I'm particular with opportunity zones. I've been mapping a bunch of the eligible opportunity zones here within the state. I've been looking at the American Community Survey or ACS data to determine eligibility and figure out where we can put these opportunity zones throughout the state.
Thank you. Okay, I'm going to try to share a screen and share some basic information. And when that's done, we can jump into questions. If anybody has a question, if you would please plunk it into the chat or the Q&A. I will periodically stop and take a look at those, and we will get them answered. Thank you. Okay. Okay, can everyone see my screen? It should say Arizona Opportunity Zones, what they are and how you can benefit. Sean, give me a thumbs up. Thank you. It's so odd what I see and don't see when this is on. But okay, so you've already met our speakers. I'm going to walk through some basics here. Opportunity zones are distressed low-income census tracts. They are nominated by governors and designated by the U.S. Department of the Treasury as opportunity zones. And I realized that was almost a little bit tautological. Investors get substantial tax breaks for making long-term investments in opportunity zones. This isn't a quick play. And the goal here is to drive investment to places that need it and might otherwise miss out. And a tract's designation as an opportunity zone lasts for 10 years. So here's a very quick and abridged history of opportunity zones. They were created in 2017 in the Tax Cuts and Jobs Act. The first ones took effect in 2018, and it's important to note that those areas remain opportunity zones through 2028, so they still have some life in them. Opportunity zones were made a permanent part of the tax code in 2025 in the One Big Beautiful Bill Act, and that comes with tighter qualifying standards and new benefits for investments in rural opportunity zones. There are new tracts that are going to get designated every 10 years now. And those 2.0 opportunity zones, which we're working to get recommendations on and make selections on now, those will take effect January 1st, 2027, and they will remain opportunity zones through 2036, which feels like a very long time from now. So just briefly, I think it's worth understanding how opportunity zone investing works, whether you be someone who expects to have some assets to put toward investment, or if you own land in an opportunity zone that you might be looking to sell. Here's how the process works. First, an investor sells an asset and generates a capital gain. It's important to understand that only recently realized capital gains benefit from the tax perks of opportunity zones. Within 180 days of the sale, generally, that investor puts the capital gain in what's called a qualified opportunity fund. That sounds really fancy, but it's not super complicated. Now, investors have to invest in opportunity zones through qualified opportunity funds to get tax benefits. I got a lot of calls after the first tracts were in place from folks who went and purchased land or businesses in opportunity zones, but they didn't do it through an opportunity fund, and they didn't use recently realized capital gains, so they did not benefit from that, at least on the opportunity zone tax piece. Now, a qualified opportunity fund may be professionally managed by a firm, one like Ed has or like Brian has. It can also be started by investors on their own. They can set up their own fund. They may be LLCs or corporations, and a fund may be created to do a single project, to invest in a single asset, or to do multiple assets. So once there's a capital gain and that capital gain is in a fund, the fund then invests in one or more assets in one or more opportunity zones. And those can be in property or businesses. And common investment types include rental housing, hotels, industrial parks, commercial properties. You heard Brian mention a school. There are a lot of things that can be done. Opportunity zones are pretty flexible. And then the investor holds the investment for 10 years because the real tax benefits come when they sell after those 10 years. So what are these tax benefits I keep talking about? Well, the first is that, let's say you have stock and you sell the stock. If you do that beginning in 2027, you put your money into a fund in 2027, that investor gets to defer the capital gains tax bill on that for 5 years, and they also get a 10% exclusion on the tax owned. So if your capital gain was $10 million and you turned around and put it into a qualified opportunity fund, instead of paying on 10 million 5 years later, you'd pay on 9 million. But if you did something slightly different, and you invested in a qualified opportunity fund that focused on rural opportunity zones, and that's where they put their money, then you get a 30% exclusion. So instead of paying on the $10 million capital gain, you pay on 7. But that's the small beans, to be honest, in this. The really big payoff comes in the investments that the Qualified Opportunity Fund makes and what happens when they're sold. So as I said earlier, the Qualified Opportunity Fund invests in one or more properties or companies. If they hold for 10 years or more, the capital gains tax can be eliminated. For investments made through 2026, which is under the old rules, investors have to sell by the end of 2047. For investments made 2027 and beyond, the value of the asset gets assessed at 30 years, and whatever growth in, whatever the capital gain is from the initial investment to those 30 years, that is tax-free. If it goes beyond the 30 years, you hold it for 35. That growth between 30 and 35, you're going to have a capital gains tax liability. One of the other perks is that there's no recapture of depreciation upon sale. And I'm going to stop here and I'm going to ask Mark to jump in here because this is one he emphasizes every single time I see him speak about it. So can you talk about the importance of that no recapture?
Yeah, so let me just do an example. So let's just say the project is a $10 million apartment building, and the building is purchased for $5 million, and they spend another $5 million and $1 improving it. So just over $10 million. There is something called depreciation deductions. So the building is depreciated. Let's just say this is a multifamily apartment building. It is depreciated over a straight line basis 27 years, but some of the equipment might be faster depreciated. So basically what that is you take the asset and you're getting tax losses over a period of time. And if you hold this asset for 10 years, at least 10 years, you will have depreciated well over a third of the building. So you may have a $10 million acquisition, price and improvement on the building, but the basis of that building might be down to $4 or $5 million. And let's just say after 10 years, you sell it for $15 million. So a lot of folks would think, okay, well, this benefit is just that incremental difference from 10 to 15 million. And that's the benefit that we get, that we don't have to pay tax on that disposition. But the delta is really the $4 million of basis and the $15 million sales price. So that's $11 million of gain. And some of that's going to be what we call ordinary income at very high tax rates. What the OZ benefit does is it says that that whole incremental difference of 11 million is tax-free. And that's what makes this so powerful. And that also is what makes this available for projects where there wouldn't be appreciation, such as an infrastructure project, an energy project, a pipeline project, where you're looking at buying an asset that 10 years from now might not be worth what you bought it for, but you will have depreciated some of it. And so if sold, there will be an incremental difference that needs to be recaptured. But with the OZ benefit, it doesn't, it gets excluded, include the depreciation recapture.
Thank you. The last thing I want to highlight is that the substantial improvement rule is halved for investments in rural opportunity zones. Brett, would you take that one and explain what that means to folks?
Sure. So generally in an OZ deal, it's required that you double the basis in the investment over a 2.5-year period. And so, usually that's pretty easy to do for a ground up construction deal, but sometimes, deals that are, out in rural areas that might, just have some infrastructure and that sort of thing, entitlement improvements, it might be harder to double the basis in a 2.5-year period, especially it's taking a while to get permits and approvals. So what the legislation did in a big, beautiful bill is it made it a little easier for those rural deals. It's only required that you put in 50% of the basis. So if the basis of the asset is $1 million, then over a 2.5-year period, it would be required to put $500,000 of investment into that asset.
And correct me if I'm wrong, the way this works is that you divide out the value of the buildings from the value of the land, and you only have to spend the value of the buildings over again, but that's what gets cut in half.
Yeah.
Right. So if it's an existing building, then you can subtract the land value. So let's say you've got, a building that's worth, 2 million, but $500,000 of that is land value. You would only have to double 1.5 million, or if it's in a rural area, you'd have to spend 50% of that 1.5 million.
Okay, thank you.
And to
So
add to what Mark was saying about another perk of bonus, you can get bonus depreciation still and still take advantage of that. No depreciation or capture after 10 years.
Okay. I want to talk a little bit about our experience so far with Opportunity Zones 1.0, which we've had in place since 2018. We have 168 Opportunity Zones in Arizona for 1.0, and we have at least one in every county. We worked very hard for a proportional distribution. So we looked at where there were eligible tracts and tried to sprinkle about a quarter of them everywhere, because we're only allowed to nominate 1/4 of the eligible tracts. So we said to communities, if you have 12, recommend 3. If you have 4, recommend 1, to try to keep a proportionality and to make sure we could spread the opportunity around. Some people are surprised to hear that our opportunity zones are slightly disproportionately rural. But we've also had a very good experience with it. There's not a lot of great reporting. That's an accident of how the bill was passed when they were created in 2017. But there's a group called Novogradac. They're a large accounting firm. They survey the folks who run larger funds every quarter. And according to their reports, and they estimate that they capture about 1/3 of the opportunity zone money that gets spent. They say that we brought in $2.65 billion through the end of last calendar year, and that puts us ahead of every single state except California. So we did a really good job bringing money in, but we also did a good job spreading it around. In 2022, the IRS wanted to know as best they could where money was being invested in opportunity zones. So they looked at tax records with a couple of researchers called Coyne and Johnson. And what they found is that looking at the first 3 years of opportunity zones, so 18, 19, 20, about 48% of US tracts that were opportunity zones had drawn investment. In Arizona, that was 72%. So we did a good job of getting money, not just a lot of money, but money spread around more generally than was the case nationwide. So how does a tract become an opportunity zone in Arizona? Well, nationwide, every governor gets to nominate 1/4 of a state's qualifying census tracts every 10 years for opportunity zone designation. And a tract qualifies to be an opportunity zone on the basis of having a lower median family income or a higher poverty rate than is typical. I will get into it in more detail later, but standards have shifted somewhat between opportunity zones 1.0 and 2.0. And once again, we're going to go for roughly proportional distribution of opportunity zones across the state for 2.0. And ACA ran this process for Governor Ducey in 2018. We are administering it for Governor Hobbs now here this year. I want to take just a really quick step back and talk about census tracts, sometimes referred to as population census tracts, because this is the name of the game, right? This is the sort of the Lego pieces that we're working with. So they're small, relatively permanent subdivisions of a county. They typically have between 1,200 and 8,000 people with an optimum size of 4,000. I will tell you in some of our rural areas, we do have tracts that have fewer than 1,200 people. These are, I use the word Lego, they're kind of like census's Legos. They're administrative geographic units. They use them to build things like congressional districts. So they put a bunch of them together. They do not cross state or county boundaries. They do wash right over municipal and tribal boundaries. And if you're looking at them on a map, they generally follow visible and identifiable features. So in an urban area, that's usually roads. In a rural area, it might be roads, but it might also be highways. It might be mountain ranges. It might be bodies of water, streams, washes, things of that sort. And in an urban area, you'll see that there's small squares and rectangles. It's pretty easy to get 4,000 people in a small square or rectangle in an urban area. If you get out in a rural area, they are large and irregular, and all of that is related to density. So that variance in density is what drives the size and the shape of the opportunity, or well, any census tract in this country. So we are just commencing right now in this process of collecting recommendations on opportunity zones and where they should go. And we know the local folks have much more up-to-date on-the-ground information than we do here at ACA, so we reach out to them. And we had an event here April 1st and 2nd around opportunity zones and development finance, and then a bunch of us went all over the state, mostly to the rural communities, and we had 12 sessions in 3 weeks to talk about this recommendation process. And it's a little different depending on where you are. If you are in Maricopa, Pima, or Pinal County, any incorporated community of 10,000 or more will be asked to recommend 1/4 of the tracts that are centered in their jurisdictions. The counties will be asked to recommend 1/4 of the tracts that are in unincorporated areas or in smaller incorporated areas. And everywhere in the state, regardless of where they are, tribal nations will be asked to recommend 1/4 of the tracts on tribal land. They will also be asked about tracts that are partially on tribal land, even if they're not centered on them. For counties outside Maricopa, Pima, and Pinal, the counties will make the recommendation for the entirety of the county, incorporated and unincorporated. And once again, tribes will speak for themselves, but for any non-tribal area in any of the counties outside Maricopa, Pima, and Pinal, it will be the county that submits on behalf of the entire county. So we know counties have been having meetings with their constituents, with their cities, with their landowners, with their major employers. We're hearing about a lot of that, which is great. If you are somebody who has an opinion on where you think an opportunity zone should be, this is a good time to reach out to your city or county folks, or if you're in a tribal area, to reach out to your tribal economic development folks or your tribal attorneys, because this process is underway. So what does it take to be an opportunity zone? I mentioned that it has to do with median family income and poverty. So in 1.0, the standard was that a census tract had to have a median family income of no more than 80% of either the state's median, if it was outside a metro area, or the median for the metro area that they were in. So if it was in the Phoenix metro, it would have to be no more than 80% of the Metro Phoenix median family income. If it's in a rural area outside an MSA, it would be the state's median family income. So that was one way to qualify. The other way to qualify is if a tract, no matter what its median family income was, had a decent concentration of poverty, so 20% or more. They tightened those standards down for 2.0. So now it's a median family income of no more than 70% of the state or metros, and that cuts out quite a few tracts. They still have the 20% possibility, but they cap the income for the tract as a whole. So that median family income cannot exceed 125% of the state or MSA's median family income. So it can't be a tract that's extraordinarily wealthy that has just a subset of poverty. So we looked at what this meant from our first experience with opportunity zones to now. So if you look in this left column here, where we look at 1.0, the state in total had 1,526 census tracts, and 44% of those qualified under that 80-20 rule. And we got 168 opportunity zones. Those are the ones we have now. If those 1.0 rules were still in place, if it was still that 80-20 rule, well, first of all, we've had a whole lot of population growth. So the state has far more census tracts as a whole. We're at 1,756 now, but only 36% of them would qualify under that old 80-20 rule. We've got 40 of them that we're not sure, they're missing some data, but that would leave us with at least 160 tracts if we followed that 80-20 rule, which you can see is less, even though we have far more census tracts than we used to. And what that tells you is that economic conditions in the state have improved. We simply don't have as many tracts in this level of distress that we did in 2018. Now, once you apply the actual 2.0 rules, where we go from 80-20 to 70-20, you can see that only 28.5% or 500 of our tracts qualify, which means we will get to nominate 125. One of the things we have emphasized to communities as we've gone up and down the state is that this is going to be an inherently competitive process by virtue of the fact that, we've gone from 1,500 to 1,700 tracts, but we're going to drop from 168 to 125 opportunity zones. The other thing that's happened is we usually go to communities and say, you can recommend 1/4 of what you have, but a great number of our communities only had 1, 2, or 3 tracts. And we asked each of them to recommend one, recognizing that that means we're going to get, I think, 142 recommendations if there's no overlap, that we're going to have to pare down to get to that 125. So we are encouraging communities or, communities, counties, and tribes that are recommending tracts to tell us why they are well positioned to benefit from the opportunity zone designation. Are they ready for development? Have they had infrastructure investment? Do they have, a letter of intent from a developer? Is there something ready to go? So we're emphasizing that because we will have no choice but to cut some of those submissions. We simply will have more than we can accommodate. So I want to just quickly talk about what opportunity zones do and don't do. Obviously, tracts with opportunity zone status are more likely to attract private investment because investing in them can yield all these tax benefits we've been talking about. But there has to be high quality investment opportunities in the zone to attract investment. Those investors want those capital gains that we've all been talking about. So the key point here is that opportunity zone tax benefits can make a good deal better, but it cannot make a bad deal good. I also want to point out that land banking does not qualify for opportunity zone related benefits, and that there is no grant money that's directly associated with the census tract having opportunity zone status. I got a ton of calls about that last time when opportunity zones were put in place. Where is my money? Where is my grant money? From landowners, from communities. And that's not how this works. It's a tool to attract private investment. Now, I will say there are some programs like the low income housing tax credit, some housing and urban development programs, some U.S. Department of Agriculture programs that will favor applications coming from opportunity zones. So while they don't automatically generate grant money, they do give you a leg up trying to get grant money. So what we've been advising communities, counties, and tribes to do is to prioritize tracts that can draw near-term private investment and deliver great outcomes for their communities. Places that are zoned and entitled, places that have power, water, and sewer or can get them very quickly, tracts that have broadband or are slated to get it, tracts that have access to roads and highways so that you can bring supplies, customers, workers, residents in, and not surprisingly, tracts that are close to people so that you have someone who can work, shop, or live in the tracts, right? If you're going to put a business there, you're going to put housing there, you're going to put a hotel there, you have to have, some access to people and supplies. So, as I mentioned, jurisdictions are considering which tracts to recommend right now. If you're interested in that process, reach out to your local municipal, county, or tribal economic development staff right now. These are all links to our website, to the map we're about to show you. I would recommend that you look at the Novogradac website. That is the accounting firm that tracks all of this. EIG is the Economic Innovation Group. They wrote the original statute for this. They've been big on this for a long time. They have a lot of information, and of course the US Treasury because they're in charge. Jurisdictions and tribes have to submit their Opportunity Zone 2.0 recommendations by June 19th. We're going to work with the governor's office to get to a final list of 125. That will be submitted this summer. Tracts will be effective, we hope, in January. We should hear from Treasury by then. And we will be working with jurisdictions and tribes on how to best market investment opportunities in the opportunity zones to potential investors. Okay, that is my entire spiel. I'm going to look real quickly and see if any questions came in. I see one in the Q&A. Chat is disabled, so we have to use Q&A. Okay. So please go ahead and do that. So if you have any questions, go ahead and do that and put them there. You can also raise your hand, and I will try to keep an eye on that. I do want to show you quickly our website. In fact, would you like to do that, Sean? Show the website, the recommendation page, and the map so people can
Sure
see what we
thing.
have there? Thank you. I think you should
Yes.
be able to share your screen.
All right. All right. Can you see my screen? Just a thumbs up. Awesome. So this is our Opportunity Zone website on the ACS site here. It includes a description about opportunity zones, a little table showing the differences between OZ 1.0 and OZ 2.0, some benefits to investors, again, detailing some of the differences, and then some important links down here. Um, Most notably, here is a link to more details about the recommendation process that we're using to kind of help to determine which eligible tracks to recommend. Fourth, it answers a lot of some questions about the recommendation process. So if you have those, you can look there. We'll also be happy to answer them during this webinar if you have any. And it includes a link to our OZ 2.0 eligibility map, which I made. If you open the map, you'll get this screen. The map has a bunch of different layers that can help educate and kind of inform not only where eligible OZ 2.0 tracks are in their rural designation, but also some other important information that might be helpful when trying to determine which tracks to recommend for nomination. You can currently it automatically opens to a layer that has the eligible tracks colored by rural designation. Non-rural are the blue tracks, so you can kind of see them here in more rural areas. If we zoom into Metro Phoenix, it's a bunch of non-rural tracks. And then the rural tracks are colored in yellow here. And then if you click on a track, your track information will automatically pull up into the window to the left. It includes information such as the median family income, the percentage of the median family income threshold compared to the MSA if it's in an MSA, or to the state if it's not in an MSA, based on the OZ statute, and then, of course, the poverty rates. And it includes information about where this tract is located, if it's eligible for new markets tax credits, and so on. And then you can always go back to the map layers by clicking here and turn on some of the other layers that we have. We also have layers that include tracks that are not eligible for OZ 2.0. So if you see a track that doesn't seem eligible, you can click on it, and again, that tract information will populate, so you can figure out why it might not be eligible for this round of OZ 2.0s. You can also learn more about what broadband investments are kind of coming into these locations. Those will populate into these little shapes here, which are colored. The darker the color, the more investment and the more, not investment, but the more homes and businesses will be served by broadband investment within that little portion, that little hexagon. So that could be helpful to kind of learn what's kind of coming into an area for broadband investment. It might help make the case for some of these eligible tracks. We also include layers showing our current OZ 1.0 tracks done with this hash marking, as you can see here. Note, census tracks have changed since OZ 1.0, so some of the shapes might not perfectly align. We also include layers that show our tribal lands using bendy dots over here, as you can see. We include ones that show the incorporated places. So those are like cities and towns throughout the state using a purple outline. So you can kind of see where the cities and towns are. And we include the counties. So if you want to see the county breakdown, those have these kind of broader outlines too. You can also search in this map by bunch of these layers. You can search by the census tract, you can search by the tribal land, you can search by incorporated place. You can also just type in an address and search that way. And when you search, so let's say I search for Peoria. I can type in Peoria and it'll populate and it'll kind of guess what you're trying to say. And I say, oh, wrong Peoria. If I say, let's go to the Peoria in Arizona, I can go in there and it'll automatically just zoom me to that area. And it'll highlight kind of where Peoria is here if I have the incorporated places layer turned on.
Sean, I have to say that the track right by Deer Valley Airport is my favorite one. I call it the rhinoceros track because it's shaped as a rhinoceros.
Do you happen to know the tract name off the top of your head?
Well, it's right there.
I
It's in the
can.
center, right?
It's like right in the center of where you are. It's
Yeah.
just
Oh,
north of the
yes.
highway.
Yeah.
Yeah.
So,
So yeah, that's our OZ 2.0 eligibility map. It can show off a lot of different functionalities. You can also go and click this home button to kind of go back, get back to the state view if you're zoomed out. And then if you have a tract that's kind of selected, you can click this clear all button and it'll wipe away your selection. You can also use this tool to create your own polygons and it'll populate with the tracks that are there and give you that information. And that's our eligibility map.
can I ask, are there any questions about the map? Okay, I think we had somebody who asked about the eligibility map link, and that's in the chat now, or in the, excuse me, Q&A now to say that. What I'd like to do, if it's okay, is ask a few questions, and then I think it's probably going to raise the kinds of things that many of you have slides for, and feel free to pop them up if that makes sense. But I want to start with our investors, with Brian and Ed, and then Mark and Brett, you also both have clients, so you can answer this too. And that's, what makes for a good opportunity investment or project? What are you and your clients looking for? And alternately, what's a red flag or a yellow flag that gives you pause or sends you running away? Ed, can you start us off?
Sure. Thank you. I think that, Sean mentioned it a second ago, but the elements that make for a good opportunity zone project are the elements that make for a good project in general. So there's this makes a good project better, and I think that's really important. But I would focus my efforts, and what I will focus my efforts on are looking at infrastructure, and I'm talking about freeways, I'm talking about wet and dry utilities. I would talk about entitlements. I think that as cities, the entitlement process has changed dramatically, just even since these came out in 17 and 18 in a lot of cities. And there's a real big benefit that could be derived there as well. And then the other thing that I would mention is, the time frame. You need to make sure that both your capital and the area are such that if these projects typically take a fair amount of time to mature, certainly 10 years to derive the full benefits. So those are the things that come to my mind initially. Brian, go ahead, and then I'll answer maybe another one of Sean's questions.
Yeah, Ed, I appreciate that. I want to definitely piggyback on a couple of things that Ed said. Definitely being in an area where you have good traffic counts. So talk about infrastructure, high freeway counts, anything near a light rail, I think is a good use for the program. And if you're in a rural community, what I would like to see for OZ 2.0 is for the communities that are near places that they have more manufacturing capacity now than they did, let's say, a decade ago, or in particular where they have more mining operations or border operations. And that means that they have a need for more heads and beds, which is housing, but also more business locations and retail. So a lot of it comes down to what is the unique individual needs of each individual community. And more importantly, does the community, the planning and zoning people, the people that are either in a county or city council, do they understand what the intent of the program is? And are they going to be amenable to making approving either zoning changes or the type of growth that the rest of the community wanted to participate when the OZ 2.0 was designated.
What are the things that are turn off, that are the things that make you look away from a project that might otherwise seem interesting?
I would say if you go back to my last comment about what is the internal political nature of a community, if you're going into an area that has traditionally been known to be very difficult to get anything new approved, that is definitely going to cause pause for a developer to want to move forward with it. So I would say that that level of political aspect is sometimes an overlooked reason why deals maybe didn't happen inside of the OZ 1.0. Ed, what are some of your thoughts?
I think the capital side is really important. If you've got a long-term project, you want to make sure your debt aligns with that. If you're looking at a project or evaluating a project that has a sort of a long-term disposition assumption, short-term financing along the way, that's those two don't go together. That can be challenging. Like Brian said, I think political support, and then look at the assumptions too. Are they anticipating, a realistic rent growth? Are they anticipating an unrealistic, cap rate compression? I would really dig into the numbers again, just like you would on another typical project.
Mark and Brett, what would you say? And if I can ask you to kind of also kick us off, what are you expecting to see more or less of in 2.0? So what's a good deal, but where do you also see things flowing?
Yeah, I see a lot of rural deals. We have a lot of clients that are setting up what are called qualified rural opportunity funds, or what the folks are calling CROFs now, um, because of the enhanced benefits for an investor investing in one of these deals, the 30% exclusion. We're seeing a lot of emphasis on manufacturing facilities because as part of the OB3, there's something called 100% depreciation deduction for qualified production property. So it is an additional benefit with respect to manufacturing facilities, and then we're seeing a lot of energy projects in the works right now.
Yeah, to add to what Brian and Ed were saying, I think the best investments are going to be projects that have a shorter construction timeline and a shorter lease up phase as well. The projects that I've seen that have done well over the last several years usually get built on time, get built quickly, and ideally can lease up favorably and stabilize. We've seen quite a lot of self-storage and industrial and multifamily over the last 8 years, and I think we'll continue to see that. I expect to see less student housing development. I think we're probably going to lose a lot of the opportunity zones that were in campus areas, but there were quite a few developers that were able to take advantage of that in the last 7 years. I also think we're going to see a lot of 1.0 deals that are going to immediately become more valuable in the last few years before the sunset. And those tracts that won't qualify for 2.0 will suddenly be even more attractive maybe than they are now in the last couple of years.
Let me switch gears a little and ask, if I'm a landowner in an area that's either a 1.0 OZ or has a shot at being a 2.0 OZ, what's in it for me and how do I benefit? And do I have to sell my land? I've gotten 2 questions about that recently. Is there some way to not sell the land but still benefit? Talk to me about it from the perspective of somebody who owns land in an OZ 1.0 or 2.0.
So there are these related party rules that are throughout the OZ incentive. So if you're selling something and trying to generate a gain to get into a qualified opportunity fund, but you sell it to a related party, you make the gain ineligible. Also, there's a rule that says you have to have at least 70% good property. So if you already own the land and you've owned it for a while, it likely is going to be bad property. but you can still make these deals work. It just a red flag goes off when you hear the word related party. You got to make sure that you're structuring it correctly. Because again, you're allowed to have up to 30% bad property. And so if I have land that we've owned for 50 years, I can still make that deal work, even though that land might be a bad asset. The improvements I put on that land will be good assets. And as long as I can get myself into a 70-30 proportion, I'm going to be fine. So these deals, when you have old and cold land, we still do a lot of these transactions. It doesn't negate them. It just means you have to spend a little bit more time structuring it.
I think you need to break down what a bad asset or bad land is.
Yeah, so if you have so there's a test and it's a 70% test, and it says that 70% of your tangible property, which would include real estate that's owned or leased, has to be good property. So if I buy property at least in 1.0, if I bought property after 2017 from an unrelated party, which means I look through my ownership chain at my buyer, which is what we call the qualified opportunity zone business, and I look at my seller. And if I look through that chain and I have more than 20% overlapping ownership on both sides, then that transaction between the seller and the QOZB is going to result in a bad asset. So if I buy the land for $2 million from a related party, that means I've got $2 million of bad assets. But if I build $8 million of improvement on that land, that improvement will be a good asset. And so I'm over the 70% test because I'm at 80% good assets, 20% bad assets. So again, these deals can work. There's a leasing structure that, not to get too technical, but there's a way to do a land lease where you can have related parties. You can do a land lease as long as that's a fair rental value. That becomes a good asset, the land lease. So again, this is an area where things we can make these things work, but folks need to be engaged with a professional that knows what they're doing.
We've definitely seen a lot more of the related party sales in recent years. Up until I think it was maybe mid 22 or 23, there wasn't much guidance on that, and it was a big no-no. But fortunately, because of that good asset, bad asset balance, over the course of 2.5 years, if you improve the land and now you've got $30 million project on land that's worth a few $1,000,000, you usually can knock it out of the park. We haven't really seen many people utilize the ground lease structure, although I know a lot of people were excited about that 6-7 years ago. The big thing you want to avoid is a contribution in. We get that question a lot, and you have to be really careful about contributing land into an existing JV or QOZB, because then there isn't technically a sale. So that's something that it can get in the way of a deal structure.
But if you just want to sell your property outright to an unrelated party, you can just go do that.
All
Yeah,
day
that's
long.
not a problem.
Yeah,
Yeah.
that's
Yeah.
never a
Now,
problem.
the
It's
other
just when
thing-
you want to remain involved and you want to still either own the land or part of the land or get involved in the investment, that's where you need a lawyer quickly, yes?
Yeah, and you don't want to have a circular cash flow issue, or what they call like a step transaction. And that would be where, I sell the land to my friend, and then I'm in the deal with them, and then I'm investing my gains from that sale into the same deal. That's a big no-no.
But I think the takeaway is, if you have folks in Arizona that have owned land for a while, they're not negated from participating in an OZ deal. That just
Right.
will be a bad asset. And again, it can be structured around.
Yep.
And we've done that successfully with Mark's help, thankfully. So, to answer your question, if you do own that land and you're thinking about it, I would look very hard at it.
Yeah, I wanna share what I've seen at Caliber, where we do get presented with a lot of different offers to buy land in an opportunity zone. And the advice that I would give the current landowner is to make sure that they're working with a commercial real estate advisor who understands the program, understands what makes a land in an opportunity zone attractive, so they're putting together the best OM or offering memorandum, and getting it broadly marketed. So it really comes down to, if you do own land in an OZ, work with an experienced commercial real estate expert that has experience and understands the OZ program.
I want to ask, and this, I think it's going to be similar, but let's try to keep it simple if we can. And that's operating businesses, right? I think when OZ 1.0 started, there was a lot of hope for being able to do operating businesses, and they turned out to be a little bit tricky. So I'm hoping, well, let me stop. I'm going to ask our lawyers first to jump in, because we do have a question about how do you view tribal trust land through the bad asset lens. But then secondly, I would like the lawyers to handle that, but then I would like our investors maybe to start with yes or no on operating businesses, and then maybe our lawyers can explain sort of some of the issues that swirl around them. So let's start with the tribal trust land through a bad asset lens.
Yeah, we do a lot of deals on tribal land, and the tribes they don't own the fee. The land is held in trust for the benefit of the tribe. So the tribes have to lease their land. And so you can have a good asset with a land lease with the tribe. And and oftentimes you have a master lease to a big master, to a master developer, and then they break off that lease into what are called substitute leases. And those are, again, you can have a good asset by owning or leasing the land. So we're able to make those transactions work. And we have done quite a few transactions on tribal land. And it was one of the things that in the regulations that we got the exception for leasing. Had we not gotten the exception for leasing in the regulations, we'd be stuck with the rule that you have to purchase the land, and you can't purchase tribal land. So fortunately, tribal land is something that is often used with the OZ incentive, and is successfully used with the OZ incentive.
And I would say the longer the lease, the better. And it can be challenging to get financing on a leasehold interest, but there are definitely lenders out there doing it.
Okay, I want to shift us over to operating businesses. Brian and then Ed, have you done operating businesses? Would you do operating businesses? What are you looking for? What is a problem?
Yeah, so at Caliber,
Brian, I think we might be losing you a little
have
bit.
done some operating businesses renovating. And in other situations, it was more because of the fact that the operating business could meet some of the overall larger objectives, job creation, what is the positive impact that they're going to have on the community. But the extra risk you run into is the operational risk, where you could have bad decisions being made by a management group, which is one of the issues about why I think a lot of people invest into real estate, because there's a perceived lower level of risk if you invest into the real estate versus the operating business. I'm hopeful that a lot of the learnings from OZ 1.0 can be used for OZ 2.0, and that we do see more investments into operating businesses under the next program.
Have you had experience with it, Ed?
We've not done a ton of that for a lot of the same reasons Brian just articulated. Sponsorship is really important in an OZ investment. And when you get into different management structures and you talk about businesses, it's a sort of an entirely different animal. That said, we're really optimistic about some of the opportunity under 2.0. We do think that there's some good clarifications here that perhaps make this even more valuable for, in some cases, a tenant. And so we're looking very hard at that.
Brett, have you seen much in terms of operating businesses? Have you done many deals with that?
We've done a few, but I think by and large, it's a little harder to get those deals done. It's harder to attract investors, in part because startups tend to like a shorter hold period, and this is obviously a long-term hold for 10 years. I think it was supposed to be a job incubator type program generating activity in low-income communities, and it has, but it's also a little more difficult to finance those deals, if you don't have the real estate collateral, it's harder to get the debt, and the debt is a huge component of almost any deal. So we've seen a few, and they tend to work, I think, better. I see them in like more closely held deals where there might be, a lease to an operator, and they might have a QOF and a QOZB on the leasehold side, and then a separate structure, on the fee side. We've seen a few of those, like in the cannabis industry, for example.
Okay. What have you seen, Mark?
Well, we've done a number of software, software startups in this space. There are these rules because it's a place-based incentive. So there are rules on where the services are performed. A certain percentage need to be in the zone. There's asset rules. It works better for a startup than it does for like a relocation into an OZ, just because you're buying new equipment, you're starting fresh in an OZ. Software is pretty easy. It's an intangible, so I don't have the same rules with respect to related party rules when it comes to intangible assets. So we've done quite a few software businesses, and other probably 10% of the deals we've done have been operating businesses. The big issue is the 10-year hold, just because folks that invest in operating businesses are usually looking for a 3 to 5 year hold period. So 10 years is on the longer side. So you have to have folks that are really willing to put their patient capital into the business.
So if I'm a landowner or a jurisdiction and I have a site in an opportunity zone that I think is a strong candidate for development, how do I pitch it? And how do I decide to whom do I pitch it? Brian, Ed, you're probably the first people to ask because you get these more than anyone, I assume.
Yeah, I mean, I would encourage. I think the Governor Hobbs and her predecessor, Governor Ducey, have done a great job of kind of working with the state and then the cities. So I'd encourage you to speak to the cities. Would be my suggestion. Make sure that they're aware of your site. Make sure that they understand kind of the assets, sort of the value proposition to the site. And I'd be very blunt, make them aware that you would like this to be included in their submittal.
Okay. But if I were pitching to you,
Pitching to
what do I
me.
pitch to you? Let's say I'm going to get an opportunity zone. I'm in it. I've got land. I might have a pad ready. I might have just put in the utilities. I might be anywhere along there, and I might either have a concrete idea of what I think should go there, or I'm open to a number of things. How do I pitch this to you?
This is the Shark Tank question.
Exactly.
I think what I would say, I'm going to answer it this way, is I would say have as much information as you can. But, Alta surveys, environmental studies, due diligence about the area, I call it the bones of the real estate, right? The pieces that are unique or specific to that. Why do you think this specific project works better than some of the others that we're seeing? And again, I would view the opportunity zone designation as sort of a cherry on top. I wouldn't lead with that. I would certainly make that part of the value proposition.
Yeah, I'll share what I felt was one of the most attractive value add deals that we've seen in OZs and how it was pitched to us. So an existing landowner had owned and bought what had turned out to be a vacant office building as a result of COVID. And they knew that they, under their traditional business model of kind of being a stabilized owner operator, just were not going to go through everything you needed to do a revitalization of a vacant office building into multifamily. So they focused on the opportunity, the shortage of housing in the area, the very low cost basis that they're willing to sell the asset at, almost below what they paid for it. And then put together a structure where they were able to actually do a little bit of a seller carry for a while. So it was structure, it was making sure that Caliber understood the future growth opportunities in the area and why this could be a unique project. So, in that case, they knew what we were looking for because we'd met at other, ACA and GPEC events, and they really customized the pitch for what Caliber was looking at based on our track record in doing revitalization projects in OZs.
We're getting close to the end, so I want to ask if I'm somebody who has an asset that I could sell, and I can either plunk money into a qualified opportunity fund that somebody else manages, like a Caliber, or I could set up my own fund, or I could say, forget this, and I'm just going to do a 1031 exchange. How do I make that decision if I'm an investor? Mark, do you want to lead us off on that one?
Well, there's a lot of flexibility from an investor or for the landowner perspective.
Investor. We've shifted from the landowner.
Okay.
We've given them all the advice they're getting. We're now on to the investor, the person who
Okay.
knows that they're going to have a realization and is
Yeah.
trying to plan for
Oh,
it.
so I'm okay. So investors can create their own fund. We've done that where folks they sell a business and they have a big gain and they create their own qualified opportunity fund. Or they can take their gain and invest in someone else's fund, like Brian or Ed's fund. The Qualified Opportunity Fund is an intermediary. So it's not going to own the hard assets. It's going to invest in another entity called a Qualified Opportunity Zone business, which is going to develop real estate or start an operating business. But the Qualified Opportunity Fund is, I call it almost like a regulated entity, right? It is the entity that has to file its tax return and say it's met all the OZ requirements or face a penalty. So if you go to someone like Ed or Brian, they're invest in their fund, they're going to be doing that hard work, for you. If you do it yourself, then you're going to have folks that can manage the process. So you're going to have good accounting folks. Plus, like I just got a call from earlier today from someone who had a big gain. They put their money in a qualified opportunity fund in September of last year. And when you do that, you have until June 30th of the following year to find a deal. So they're running up against this June 30th date to find a deal, and they're still looking at deals, but running out of time. So if you go to like Ed or Brian, put your money into their qualified opportunity fund, they're going to do that hard work for you so that you don't have to do that yourself.
Yeah, I'm
Who's
actually
the
going to
Mark?
piggyback on that with Mark,
I'm sorry.
because we do have that experience where we have investors that have set up their own qualified opportunity zone fund, and maybe they've started making some investments and they realize that they literally created a job for themselves, and they needed to focus on their own business, their own lives. So in that instance, they have a couple options. One, we have actually conducted a merger of an existing opportunity zone fund into ours, which obviously Mark was able to help with. And then also, we do have people that they set up their own fund and then they can invest directly into a QOZB deal that our fund is also the lead investor into. So it really comes down to what is the investor looking to achieve? How active or passive do they want to be? And if they want to do their own deal, but they can't find the right options, then they can come to someone that already has a qualifying deal to be able to execute on that.
So let me ask you, Brett, when you think about your clients, for whom does it work to do their own fund, and who is better off going into somebody else's fund?
Almost everybody can set up their own fund. It's pretty easy to do. And like Brian said, it's not that hard to invest side by side with a group like Caliber into a QZB. So, if it's a smaller mom and pop or family type operation, it usually makes sense to set up your own QLF. You've got a little more control over investment strategy. You've got a little more control over economics. Maybe you have a deal in mind, right? Maybe you're setting it up for a particular deal that you do want to develop. On the flip side of that, like Brian said, maybe you don't want to deal with the administrative and cumbersome compliance requirements for the next 10 years. There's going to be, certain type of CPA that you have to hire. So, and maybe you don't want to be a developer. Maybe you just want to be more of a passive investor. So even if you have your own fund, you can still maybe fit into that mold. And we've seen a lot more of that over the last 2 or 3 years, and I think we'll continue to see that. I especially see it with like more sophisticated investors. If they're contributing like more than $500,000 or $1 million, oftentimes they will want to set up their own QLF.
We're stretching just past an hour, so I'm going to ask in closing because I don't see any additional questions in the chat or in the Q&A. Oh, hold on, let me just verify that. Hold on. Yeah, there are no open questions. Last piece of advice to the general public, as here we sit with 1.0 still active, 2.0 in the recommendation process, landowners, community folks, investors, what's your sort of final piece of advice to them? Brett, we'll start with you.
I would say don't let anyone tell you it's too late to do 1.0. And it's not too late to do a deal this year even. And at the same time, I think there's going to be a tremendous uptick in volume and activity starting next January. So I think this is one of the best times to get involved in the OZ incentive space, and hopeful that we'll see more and more investment throughout Arizona in the space.
Okay. Mark, what's your
Yeah,
advice to
I'm
folks?
going to add to what Brett just said. Even if you're in a 1.0 tract that doesn't get redesignated in 2.0, that tract is good for 2 more years. So you have until the end of December. You have December 31, 2028, where it's still eligible. It's still a designated tract. And so we're waiting for transition rules. There was a proposed safe harbor that the real estate roundtable sent to the IRS about a month ago, and they were proposing. I heard the Treasury Department's giving it a hard look, and that is if you have by the end of December, by December 31, 2028, if you've made at least 10% of your investment into the project, that you would safe harbor your project in 1.0. So again, if you're in a tract, it's going to lose its designation. There's still 2 years to get a lot done and grandfather. I think Treasury is going to be very lenient on the grandfathering rules. So it's not too late, and don't fret if you don't get 2.0.
Okay, I'm going to stop you right there only because I've got one other question that just came in. Can capital gains earned in another country be invested in an opportunity zone and get the full benefit?
Yeah, I don't know why that wouldn't qualify. As long as it's a capital gain and it's taxed under U.S. income tax law.
Okay. Brian, your advice to community members, jurisdictions making recommendations, landowners, people who might have potential gains coming up or considering opportunities in investing, what should they be thinking about and paying attention to? What's your advice to them?
Yeah, I want to cover two things really quickly. One, if you have a current eligible gain for this year that could have actually happened last year as well, you're in a very unique situation right now. You may be able to invest into a fund before the end of this year that will actually be able to use some of the IRS accepted rules because of investing into a privately held, non-controlled entity, and potentially be able to reduce the amount of your eligible capital gain by the amount of the reduced market value because you're investing in, let's say, an active construction project. So that's one thing that I think sometimes gets overlooked. If you're an investor this year, it's a very unique opportunity. From the community aspect, look at what you want your community to experience between now and the next 10 years. And make sure that you're making the decision of what eligible tracts that you submit to Arizona so that you're putting your best foot forward.
Thank you. I just want to say I got a question. Could we share the slides? I'm either going to send them out or post them on the website. I'll figure out which one is more doable, but watch for that in the next few days. We'll make sure you get them one way or the other. And Ed, you get the last word. What are the things you want folks to be thinking about, considering whether they're landowners, communities making recommendations, people who might be having a gain what should everybody be thinking about Opportunity Zones 1.0 and 2.0 right now?
I would take a real close inventory of your land, your portfolio, see if you are going to be 2.0 eligible. If you didn't make the cut at all, then you know that now. But if you did, you may. So be aware of that. And then try to, the idea of having 1.0 designations with 2.0 rules, making an assumption here that Treasury is going to make those transitions fairly easy, like Mark just mentioned a second ago. I think those 2 years is going to be a real highlight of these programs, and that's something we're keenly focused on right now.
Wonderful. Thank you all. I really appreciate your participation. Thank you to all of our folks online who have been with us for this last hour plus. Please stay tuned. Keep an eye on our website. We will have lots of good information there as things develop. Thank you, and everybody have a terrific afternoon.
It was great
Thank
seeing
you.
everyone.
Thank you.
Thank
Appreciate the
you.
opportunity.